Welcome everybody. I'm Trish from the Johnson Center and I'll be assisting today. Just wanted to let everybody know that it's great that you could be here on a Monday afternoon. Thanks for taking the time. So today, as we get going, we'll start with a few brief housekeeping notes for you. We encourage you to ask questions throughout the session, and you can do this by typing in the chat. If you have any technical issues as well, you can feel free to message me directly and I can help you with that. And then while the presenters are speaking, we ask that you please keep your mics muted. We'll have 2 opportunities today for our presenters to pause and answer questions. And with the opportunity at the end of the presentation, we can have folks raise hands and ask questions more free-form outside of the chat. And then just rest assured that the webinar is being recorded. So you will receive a link to the recording and the PowerPoint slides after the session. So with that, I'll turn it over to the Executive Director of the Johnson Center for Philanthropy, Dr. Teri Behrens. Teri?
Thanks, Trish, and welcome everyone. Delighted to have you join us this afternoon. The Johnson Center is at Grand Valley State University, and our mission is to understand, strengthen, and advance philanthropy. I think the research that we're sharing with you today really helps further all 3 of those goals: understanding, strengthening, and advancing. I'm going to introduce our research team for the presentation today. We're fortunate to have with us Brittany Kienker, who is the Knowledge Insights Expert in Residence for the Council of Michigan Foundations, and CMF commissioned this work. So I want to thank them and welcome Brittany from CMF. Casey Veach is a manager at Plante Moran, and Jeff Williams, director of the Community Data and Research Lab at the Johnson Center. And Casey and Jeff were the 2 primary researchers on this. I'm going to just go over the agenda. So Brittany will be starting us off with a little bit of an introduction and some background on previous research that has been done on this. And then followed by a summary of some of that prior research on investment returns that Casey will walk us through. Jeff will lead us through the analysis on foundation payout rates. And then Casey and Jeff will share some of the more recent research, going over some of the different scenarios that they ran for this research. And then finally, we'll end up with some conversation space for Q&A. When we presented the private foundation study last month, many of you may have joined us for that. And we made the point then that this was surfing across, not swimming through the data. So today's session is meant to provide some more technical detail, a little bit deeper dive into the methodology that was used, how the calculations were done. And so that will, for the data nerds in the group, we hope that you particularly enjoy this and you'll get some more of your detailed questions addressed here. So I'm going to turn it over to Brittany to make some opening and closing comments, but the bulk of the presentation today will be from Casey and Jeff as the respective project leads. Brittany?
Thanks, Teri. So I was first introduced to the concept of the payout study, I think it was probably 6-8 months ago, and found out very quickly that CMF had a long history of involvement in commissioning research on private foundation payouts specifically. Starting in about 2000, they have had 4 separate studies that were conducted by Cambridge Associates. These studies looked purely at the data that individual foundations could submit. So it was very much a sampling methodology, using about 48 of Michigan-based foundations, and then some of the later versions of those studies had some very brief comparison to national foundations. So while that was helpful to us, when the project team had a chance to sit down and say, what do we want to do with this? What can we bring to the table that Cambridge Associates didn't do, research that and data that wasn't available at early stages of that research? We kind of came up with a list of things that we said, we absolutely should look at these issues. One of the very first things was to say, we have to look at a more comprehensive database of private foundation data coming from the digitally accessible 990 PFs, and then in phase 2, looking at the 990s more broadly for community foundations. So what this does is it gives us access to roughly 80% of the private foundation universe in the US, both by number of foundations and by assets. In further discussions, especially from our colleagues at Plante Moran, they've said, when you look at foundation assets, international equities are a big piece of that. And so we wanted to add that to the methodology in a way that was not included in the earlier studies. We also wanted the ability to look at not only, okay, we want to calculate what's going on, but also looking at broad modeling and saying, here are some of the issues and questions that are going on across the field. Let's dive deeper. Use this really wonderful data set of 990s and 990 PFs to actually model what are some of these ideas and how does that pan out for institutions in the field, as well as for broader advocacy and public policy debate going on. So with that, I will pass it on to Casey.
Thank you, Brittany. Good afternoon, everyone. My name is Casey Veach. As Teri mentioned, I'm a manager in Plante Moran Financial Advisors, which is the investment advisory arm of Plante Moran, which you may know as the public accounting and consulting firm. And so I wanted to start today with just a quick recap of some historical investment returns as it relates to model portfolios that were introduced within the Cambridge studies. All 4 studies included these model portfolios that were roughly 35% fixed income and 25% fixed income to represent models to analyze historical returns. When Cambridge did the first study in 2000 and really was looking back to historical investment returns going back to 1970, they looked at a portfolio of all US stocks and US bonds. And so when we revisited this analysis, in particular for the period from 2014 to today, we wanted to be a little bit more representative of how we feel investment portfolios for most private foundations would look during that time period from 2014 to recent. And so we included a component of international equities within those model portfolios, which wasn't there previously, as Brittany had mentioned. On the next slide, when we look at how those model portfolios look relative to the longer term historical periods that were included in the previous Cambridge studies, which is in the top table there, table 2, we can see from 2014 to 2019, the model portfolios returned roughly 5.6% and 6%. And when we compare that to the longer term historical periods in the previous Cambridge reports, that's pretty much right in line with what we saw over the long-term periods going back to the 1973. All of the periods returning somewhere in between 5 to 6.5% annualized, with the 1986 to 2009 period in particular sticking out as slightly above average, both model portfolios returning over 6% on an annualized basis during that roughly 33-year period. The individual calendar year returns are shown in the table below there for each of the model portfolios. And then just a quick note for this slide, as well as the future slides in the presentation, any investment return numbers or asset balance later on in the projection slide towards the end of the presentation are going to be referred to in inflation adjusted or real terms, unless otherwise noted. And then any investment returns for periods longer than 1 year are going to reflect annualized return numbers. So I'll pass it over to Jeff to talk about the data source for the 990 PFs.
Thank you, Casey. Jeff Williams with the Johnson Center. And this was one of the largest studies we used our new data source. And this is actually a publicly available source. In 2016 or so, the IRS announced a new partnership with Amazon Web Services. So out on the big cloud storage at Amazon, the IRS announced they would start publishing 990, 990EZ, and 990PF forms basically on a nightly basis. As they were processed and turned public and the IRS is done processing, they would create new files every night. This is a very easily accessed data source, but not for the faint of heart. Everything is in basically an unlabeled XML file. So there's a lot of trial and error and chatting with other folks including the Open 990 resources. With the team at the Johnson Center, we were able to set up basically an automated sweep. So each Friday night, very early Saturday morning, Johnson Center servers go out to Amazon, sweep and grab only the new records, bring them into our database for processing, and kind of set up from there. It's almost 3 million records in this data set right now. And I put a table on the right so you can see, even though they kind of say it's 2013 to the present, you can see there is kind of a tail that goes back to 2010. But I certainly wouldn't treat 2010 as representative with only 755 records. Important to note as well, this represents any of the electronically filed returns with the IRS. So the paper-based returns are not included in this data set. There is a mandate to do electronic returns. I think that takes effect with the 22 tax year. So as time went on, certainly as we hit 2016, 17, and 18, we're getting more and more filers filing electronically because they know that deadline is coming. There is another data set the IRS makes available called the Business Master File. That's the universe. That is the absolute universe of every certified nonprofit. By comparing the number and the assets of records in this, what you see on your screen, the electronic filers, with the universe, that's how we know in our data set, we've got 85% of the nation's private foundations and 77% of the assets. On the community foundation side, about 90% of all community foundations are electronic filers as of 2017. That's about 83, 84% of community foundation assets. So we're not to 100%, it's not a full census yet, but with 85 to 90% of the universe in, including most of the large foundations, the numbers are very solid as we look from a statistical standpoint. So that's just a quick tour of the data source that we used to calculate the actual investment returns and the actual payout rates for both the private and the community foundations. And I'm going to turn it back to Casey to start digging into some of the detail and returns.
Thank you, Jeff. On the next slide, we outline for the private foundation report the formulas and different 990 PF fields that were used to calculate the investment returns, as well as the payout rates for the foundations themselves. And so don't want to go through each of these line by line, but effectively for the investment return calculation, we used a similar formula to what was used in the Cambridge reports, which was actually based off of an IRS study, a previous study from the 1980s. And so the methodology is consistent from the previous Cambridge reports in terms of calculating those returns. And then for the payout rates for private foundations, using the actual line items from the 990 that are used within the 990 PF to calculate those payout rates for qualifying distributions. For the community foundations on the next slide, for the investment return calculation, we did try an additional alternative calculation just to see if we came up with similar results, which we did. And based on the fact that the 990s for community foundations have some slight differences from the private foundation 990 PF forms. And so we looked at an alternative method. It came up with similar results, which will be in the community foundation report and technical appendix when that is released. But ultimately, we ended up using the similar formula that you see here within this table to make sure that it was completely comparable from the 990, from the community foundation study, excuse me, to the private foundation study. For the payout rates, again, because the fields are slightly different between the two foundation types, we tried a couple of different methods, ultimately with the goal of trying to determine a way to make the payout calculation at least somewhat comparable between the two reports. And so what we did for community foundations is we looked at grants paid out, and then we also included a portion of administrative costs based on the relative portion used for the private foundation studies to come up with what we believe was a similar or at least comparable calculation to the private foundation study so that we can look at the payout rates for the two side by side. On the next slide, looking at the calculated investment returns from the private foundation study, this is for the Michigan private foundations relative to the model portfolios. You can see here each year for 2014 to 2018 displayed, as well as an annualized number there at the bottom for the 5-year period. It's important to note that that 5-year number is strictly just a geometric average of the 5 years that you see listed out above. That is not the median 5-year number or any particular foundation, if you will. It's just taking the average of the 5 calendar years that you see in the table above that. When we look at the private foundation returns relative to the model portfolios, both the 35% fixed income as well as the 25% fixed income, you can see that private foundations, the median private foundation, fell below both model portfolios, returning about 1% per year over that 5-year period from 2014 to 2018, relative to the models returning about 3.2 and 3.3%. Looking at how that breaks out from different percentiles, going beyond the median to look at 25th percentile and 75th percentile, you can see the range that the Michigan private foundations displayed throughout the different calendar years. Of particular note, you can see that in positive years, the median, this is shown on the prior slide, but the median private foundation tend to underperform the model portfolios in up years, while years that were down markets or down for investments, the median foundation tended to not quite lose as much. On page 14, just comparing the Michigan data relative to the national data for both private foundations, which is on the left-hand side, as well as community foundations, which are on the right-hand side. And again, the community foundation data will be released later this month, but we wanted to provide it in today's presentation to give kind of a sneak peek into some of the data for that report. Private foundations, again, for Michigan over the 5-year period returned 1%. That was right in line with the overall national data of 1.1% annualized returns for that same 5-year period. And we saw a similar story for the community foundations, both Michigan and national, coming out to relatively very similar numbers at 1.6 and 1.7%. And you can see community foundations returning slightly more than the private foundation data, although still lagging behind the model portfolios at 3.2 and 3.3%. And I will pass it back to Jeff to discuss some of the payout rates.
Thanks, Casey. So for the payout rates, we're going to focus on the private foundation side, partly because the community foundation study is done. It's just in final approvals now, but also because there were some really interesting details and some oddities in the data that emerged on the private side that weren't there on the community foundation side. And we thought that would be more interesting to dig into with this group. So when we look at foundation payout rates, this is what we see. So part of the question from CMF was, now that we have access to this universe, how do we compare, how do foundations payout compare to the mandated 5% under federal rules? And the answer is very well. The median is above 5%, 75th percentile well above 5%. And these figures, these are the Michigan private foundations across the 2013 to 2018 period on this slide. And those same figures, that same picture, was almost identical on the national side. And here is just that table showing you that national numbers. You can see the Michigan in the top 6 rows, national in the bottom 6 rows. And if you pick the same year, and I'll just look at 2013 median Michigan was 5.8% payout, almost identical to the nation at 5.8% there, with a much larger number of foundations. The private foundations as well, they're simply more numerous. There are about 900 community foundations in total across the United States. There are tens of thousands of private foundations. So in terms of a robust data set, much more robust here. Community foundation, another preview, the numbers are going to look very, very similar to what you see on this slide when those calculations were completed. Digging a little bit further, we wanted to look at the distribution of the payout rates. And this is when we had 2 kind of oddities pop up in the data. When we first ran this histogram looking at percentage of payout rates and then how many foundations made each of these rates, we noticed that the 75th percentile foundations were reporting paying out 90% or more, 90 or more, with a number of foundations paying out more than 100% of their corpus. That, of course, is logically impossible. A foundation wouldn't last long if it paid out 100% of the corpus. So because we had access to the full 990s, we could dig in and figure out the answer. And then what we discovered was there's about between 20 and 25% of foundations, private foundations, receive close to 100% of their corpus as new contributions in any given year. Meaning in kind of plain English, they act a lot more like a fund than a foundation. I mean, they're not living off their endowment. They're still getting contributions in from their private foundation sponsor. So to adjust for that, what we did was for any foundation where the payout rate on raw calculation was 100% or more, we reset the denominator to be the corpus plus all of the contributions received during that year. So when we make that adjustment, the table you saw on the prior slide and this table, this is what results. So this is already after that adjustment was made. When we do that, we see that nearly 70% of Michigan's foundations paid out more than 5%. Half paid out 6% or more. And again, like in the prior on just the straight out payout rate, the national numbers are almost identical to these numbers in Michigan. So we're just going to focus on the Michigan table here. The bar chart and the pie chart for national private foundations, almost the same as what you see on the screen. The second thing we noticed when we looked again at that private foundations is there was another group, and that was there were a number of foundations, again, about 20-some%, where 90% or more of the corpus balance was paid out. So we split those out again and called them kind of their non-endowed foundations. So this is a term of art. It was a term that doesn't exist in literature. We kind of created it to separate out the analysis. And again, get at some of those fund-based instead of endowment-based foundations. Then we split it out and said, okay, what's the median payout of these kind of foundation funds versus a traditional private foundation? You can see those non-endowed foundations, their median payouts were close to 60-70% of the endowment, whereas a typical endowed foundation that does not receive incoming contributions, hovering close to that 5.5-6%. Again, just to split here, and again, we expected this to see that payout rates were lower for the endowed versus the non-endowed, those foundations still receiving a wealth of incoming contributions. But again, the payout rates and distributions well above 5% at the median for both, and again, non-endowed much, much higher than 5%. Casey and I wanted to stop there because one of the things we learned in walking through this study, both with CMF and the prior webinars we've done, is there's a lot of information to dig through, and we're about to kind of start messing with all the numbers and putting some different scenarios on front. So we wanted to pause here for a first round of questions. So I'll invite Casey back on screen and then see if, Trish, if there are any questions in chat that we should cover right now.
It looks like we're good so far, Jeff and Casey. Anyone, if you have any questions, go ahead, put them in chat and we can take a few minutes. Otherwise, I think we can continue on. Let's see here.
All right, we'll give folks just another couple of seconds as we get ready to start changing the payout rates and changing the investment return assumptions and see what the effects are on foundation endowments, the next part of our presentation.
All right, looks like we've got a question from Tom. Once you broke up the endowed and non-endowed foundations, were there any other surprises on payout?
That's a good question. I'll just back up one slide. It was interesting to me that non-endowed group, just the big spread. You can see that 25th percentile paying out and get that kind of 40 or 50% of payout, up to the 75th percentile paying out basically their whole corpus and more. Once I ran the data, again, my assumption, once Casey and I kind of figured out how you could pay out more than 100% of payout or 100% of corpus and realized it was the contributions, my assumption was, oh, okay, I know what's going on. There's some foundation that got created and just randomly in 2015 is when they really had a big influx of money. But in the other years, they behaved more like a traditional private foundation. That simply wasn't true. What we noticed is that these kind of non-endowed foundations year after year were receiving substantial contributions in. So it was the exception, not the rule, that the money was flowing in. That's certainly, again, not the case for all non-endowed, but I was surprised by the number of foundations, private foundations, that received regular inbound contributions. I think that took both Casey and I a little bit by surprise. Just if you had stopped us on the street and asked to kind of guess. Casey, I don't know if you want to make any other comments on that endowed, non-endowed, but that was I know that took quite a bit of digging from both of us to figure that out.
Yeah, I think you hit the nail on the head there. Just the number of funds, money in, money out types of foundations was higher than we had expected.
And similarly, the number of foundations, honestly, where their endowment is sitting in cash, meaning as we look at that 990 PF, it was, again, 15 to 20% of the private foundations did not report a stock or a bond. Their endowment was held in cash or traditional bank accounts. That was also a surprising share to both Casey and I. Trish, I think I saw one other chat fly by, but I could not catch it on my presenter screen.
Sure thing. Yeah, Jeff, we have another question from Philanthropy Delaware. Hi, thanks for this information. Can you please define payout? Does this include administration and investment fees for the private foundations?
Casey, do you want to take that one?
Yeah, so the payout, just kind of going back to slide 11 with the calculations that were included. For the private foundation study, we used the 990 field for net value of non-charitable assets. And so for the corpus amount and then for the payout amount is going to be adjusted qualifying distributions. And so there is some component of administrative costs that would be embedded into that qualifying distribution definition associated with the 990 PF data field.
Great, thanks, Casey. We also have one more question from Lauren about the non-endowed foundations. So are they fundraising annually is the question?
Yeah, I don't know that it's fundraising annually so much as, and again, think of a family foundation that's set up as a private foundation, and not to put too fine a point on it, but mom and her dad aren't dead yet; they're still here. So kind of the major funding event hasn't happened yet. I think a number of private foundations are seeing that kind of family giving and using it as a philanthropic vehicle before the big endowing event occurs and happens. And that's my hypothesis, just based on, again, since we have the full 990s, I can look at when the private foundation was created, and a number of them, these kind of heavy cash inflows are within the first 5 and 10 years of the foundation's existence. I didn't see a lot of private foundations that were 40, 50, 60 years old with heavy inbound cash donations. So that's why I'm thinking it was an endowing event that hadn't yet occurred, but the vehicle had been set up. That's, again, just a hypothesis that I can show anecdotally in the data, but not something I could state as a research fact.
Yeah, I think another component of that, Jeff, was when we looked at a couple of foundations in particular, this was not a one-off event for a single year within the 5-year period. Most of them were contributions and distributions consistently for all 5 years across the same foundation. And so it wasn't something where it was a random event where the foundation had 1 year where they had a large contribution. It was consistent from year to year.
Yeah, and you remind me, Casey, I was, 3 years, 4 years, 5 years was very, very common. That, 1 or 2 was not that common at all. So it was a very recurring piece. Absolutely correct. All right, Trish, I think, shall we press on?
I think so. We'll have another opportunity at the end for folks. So hold on. Thanks.
Very good. So in kind of the second half of our 2-part story, now we wanted to kind of start playing around with the goalposts. So in the conversations, as Brittany talked about, the Cambridge studies, which again, this study lines up very nicely with, really were kind of rear view mirror looking. They documented what had happened in the past on that sample of foundations. We wanted to take a look at what happens if you increase the payout rate. What happens if future market returns are higher than an average return? What happens if they're lower than an average return? So as part of this study, we were able to kind of change some of those parameters and then model those differences going forward. So that's what we're going to do now, is talk about kind of changes to the investment horizons or investment forecasts, and also changes to the payout rates. So I want to talk first about changes to investment returns. This is kind of a history of returns, and I declared a new period here in conversations with Casey. In my economics and finance training, a lot of it revolves on, you talk about the economics world before and after World War II. And as Casey and I were reviewing the data, we looked at it too and said, but there's a different era, which is we're calling the internet era. So we kind of drew a dividing line to say, Cambridge and other studies had gone back to 1972. What happens if we look at kind of the internet era, meaning after World War II, there's a new economy that's been created, or at least heavily influenced by computers. What are those returns if we limit ourselves just to look at the investing horizon, 1989 to 2019? And what you see is, as we know just from the popular media, equities did very, very well. Bonds did very well during that time. And again, we selected 1989. There is method to that madness. The World Wide Web was conceptualized at CERN in Switzerland in 1989. So it's kind of a good defining mark, even though it would take a couple of years for the web to be commercialized at all. That's kind of a good arbitrary yet defensible dividing line. So when we use that internet era and look back at the Cambridge studies, so the Cambridge prior work is the first 3 rows of this table. The internet era return is the bottom row. And again, you can see that the internet era in both of the model portfolios is above and was more lucrative than prior study periods. So armed with this information, we turned, and this is why we were thrilled to partner with Plante and Moran at the Johnson Center, is to use their expertise in financial modeling to say, okay, if the future is more like the internet era than other things, and we have these model portfolios, what might this mean for investments? So I'll turn the mic back over to Casey to talk about some probabilities as we head toward forecasts.
Thank you, Jeff. So just to kind of reiterate what Jeff just said, what we're doing in the next few slides is taking that internet era and the characteristics as it relates to investment returns, standard deviations, and correlations among investments to then use a Monte Carlo analysis to project out investment returns based on that time period. And so if we look at slide 23, just to give some rough numbers in terms of the different scenarios that we looked at and the probabilities associated with that modeling. Again, the 3 scenarios that we looked at for payout rates, starting with the far left-hand columns, are a 5% annual payout for each year, so a consistent 5% number. And then the right-hand columns there for 7% and 10%, those scenarios were a 3-year temporary payout at those increased rates, and then a 10%, and then reverting back to a 5% thereafter. For this chart in this table, what we wanted to look at was for each of those levels, 5%, 7%, and 10%, what is the probability of the model portfolios achieving each of those rates of return on an annualized basis over a 10-year period, to give an idea of the probability of achieving each of those, again, based on the projections mimicking, if you will, an internet era type of environment. On the next slide is some of the source modeling data, if you will, to create that previous chart. Just to give the readers an understanding, all of these charts were included in the technical appendix. But to just use one example, for the probabilities of achieving a 5% return or a 7% return, what's important when looking at this type of data is the time horizon. And so if you look at the 1-year column, in any given year, the probability of achieving a 5% or a 7% return is roughly a coin flip, 53% for the 5% number and 47% for the 7% return, given the internet era assumptions. When you extend that out over longer time horizons of 5, 10, and we ultimately looked at out to 25 years just to see what the numbers were. But specifically for a 10-year number, when you look at those 5% and 7% thresholds, again, the probability of maintaining a 5% annualized return over a 10-year period, and this is for the 35% fixed income portfolio, is about 59%. And then when you look at the 7% threshold, the probability of maintaining that over a longer time horizon is lower than what it would be over a 1-year period. And so that reduced down to 35%. And those numbers are reflected in the table on the previous slide. On slide 25, what we've done here is we're looking at the temporary payout scenarios that I had referenced earlier. And so we constructed these to see how the temporarily increased payouts over a 3-year period would impact the real asset balance for a foundation. And we just used $1 million as a starting point and an example over a 10-year time period. And so what this chart is showing is, again, the probability of maintaining the real portfolio value of $1 million under each of those 3 temporary scenarios. And this is really going to be based off of and feed off of the returns that we just showed on the prior slide, where if your probability of maintaining a payout level or a return above the payout level is greater than 50%, then your probability of maintaining a real asset balance of $1 million is also likely going to be 50%. So what we saw for the temporary payout scenarios of 7 and 10% was a less than 50% probability of maintaining a real balance given those increased spending scenarios that we constructed. And again, just to highlight on slide 26 on the next slide, some of the underlying data that goes into that table. Again, starting with $1 million, and what we're doing here is we're spending 10% of the balance for the first 3 years, and then 5% for every year thereafter. And if you look at the median line within the table below the chart, that gives you an idea of where that median asset balance stands at each point in time for the first 10 years across, starting from the left-hand side and moving over to the right, to the point where after a 10-year period, you can see the median asset balance is about $912,000. So still below the initial $1 million starting point, and this is for the 10% scenario again. Plugging in a 20-year forecast period just to see how long it might take to get back to that $1 million starting point, you can see under the 10% scenario, you don't even get back to $1 million of real portfolio value even after 20 years. You're slightly below at $985,000. On the next slide, this just highlights effectively in a line chart form the data from the previous slide summarized from 1-year time horizons out to 20-year time horizons. That darker red line at the bottom there is the 10% scenario that I just outlined, where it shows the median balance over those time periods. And you can see at the 20-year mark, still just below the $1 million starting value. And so you can see over time how those increased payout scenarios, even for just a 3-year increase, how that affects future asset balances of the foundation. I'll pass it back to Jeff.
So as a charter member of the Data Geek Club, as soon as Casey and the team showed me that we could do other models and this the internet era was higher than expected returns, of course, my very next question is, great, what happens if there are lower than expected returns? So in this next part, we just wanted to talk about the forecast. Looking forward from 2020, certainly, if you went back to 1989, federal interest rates and federal funds rates of under 1% were unheard of and absurdly historically low. That's where we're sitting today. So we also, if the internet era could be considered kind of an optimistic or a newer model, we also wanted to take a different view and look at, well, what does the world look like of future returns in a world starting from where we're at now with incredibly low interest rates. We want to make a comment here, both from the Johnson Center and the Plante Moran side, Forecasts are forecasts. They are approximations of the future. We do not pick that this is what's going to happen and be predictive, but rather we're trying to use this as a way to kind of put a bracket. What's an optimistic or pessimistic? What's a high end and low end? What are some ranges that we could see, and then run it back through that 5%, temporary 7%, or temporary 10% payout to see what effect that has on foundations. I love the saying, all forecasts are wrong. It's just that some are useful. And that's kind of the spirit in which we attempted this, was to look at a series of forecasts and how that changes the data going forward on those different payouts. So this is what we see when we look at the median annual forecast and the odds of earning that kind of baseline 5% return. The dark orange is the forecast, meaning starting from the current interest rate and equity environment and projecting forward. This is what could happen. And the internet era that Casey just walked us through is that lighter kind of salmony orange line, the peach line up above. You can see in terms of the median annual return, we're somewhere between 4 and 6% pretty consistently across that time horizon of 5 and 10 years. But there's a different story when we switch to the probabilities, the odds of earning at least a 5% real return. There you see a difference where the internet era says the odds increase with time, that compounding effect takes hold. The forecast says that actually the odds decrease as we go forward because of the lower forward projecting environment. If you put it all together and say, let's take a look at, again, as Casey said, what if we do it per $1 million of endowment? The blue lines show that kind of internet era or the higher end estimate of at 5, 7, and 10% draws across a 10-year period. The peach, orange, and red lines show the forecast. Same series, 5%, temporary 7, temporary 10% draw, and how that $1 million has changed over that 5 and 10-year period. So you can see we have everything kind of inbounds from an endowment of $1 million today, shrinking to 750, just shy of 800,000 in 10 years, kind of the highest draw and the worst economic performance. The other extreme, we go to about $1.1 million, a growth of almost 10% over a 10-year period, with the smallest draw and also the best economic forecast that we ran. So this, again, our point in doing this was not to set that one of these is more right than the other, but again, to show that range of possible criteria, or the range of possible outcomes as we vary both the investment horizon and forecast and the way in which a foundation is drawing upon its endowment. So I'll turn it back to Casey to wrap us up here and as we head toward conclusions.
Thank you, Jeff. One of the last things that we wanted to look at in this chart on page 31 is effectively the same data as the asset balances that I just reviewed on slide 27, but looking at it from a different perspective. Instead of saying, getting back to $1 million portfolio, real portfolio value, what is the impact on that payout that the foundation is ultimately giving out from the 5% payout, or in the other scenarios, the payout that's occurring for that particular year. And so when you look at those in relative dollar terms, using a $50,000 payout, if we have a $1 million balance and we have a 5% payout, that would be $50,000 in year 0, if you will. How does that compare over time to the real payout levels under these multiple scenarios? And that's what we've outlined here on slide 31, is in real dollar terms what the payout is for each year, years 1 through 10. And you can see in these 7 and 10% scenarios, yes, you have a payout that is larger than the initial $50,000 for those first 3 years. But then when you look at years 4 through 10, you have a payout that is going to be below your kind of benchmark, if you will, $50,000 real payout, which would be representative of a 5% payout from that first year when you had $1 million within the foundation. And so that's just another way to present that same data as what it means for ultimate grants that get paid out from the foundation. And again, on slide 32, just to kind of review the backup modeling that goes into that. This is showing the 7% scenario, and you can see in the median line item there what those dollar amounts that get paid out, assuming median returns, end up being. And so just another way to view it, again, going to be the same conclusions drawn as the asset balance or the returns, just a third way of taking a look at that data.
So as we wrap up here, I think Casey and Brittany and I all have one final slide, and then we look forward to your continued questions. So looking only at the investment return side, expecting annual returns in excess of 5% is not sustainable on a real basis. Certainly possible on kind of 1, 2, 3 shorter year horizons, but you get out to 5 and 10 years, and it's not in the math. And not in the math means the probability of exceeding 5%, as Casey said earlier, it's just over 50%. It's just over a coin flip at that 5% as we ran the models forward. Those two statements hold no matter which model portfolio we used, whether we used the 35% fixed income or the more aggressive 25% fixed income. We also ran those with and without international equities. So adding international equities into the mix did not change that overall conclusion. And when we ran the numbers, again, using that massive data set and looked at the 80% of the universe that is filing electronically, both on the private and the community foundation side, the actual returns of the median foundation were below 5% annually, 2014 to 2018. They were below that in Michigan, and they were below that in the United States. So again, that median foundation was below the model portfolio, kind of no matter which way we looked, and no matter what type of foundation we looked at. Looking at the payout rates, kind of switching the discussion to the payout rate side. Again, these conclusions are for the private foundation side. Again, previewing the community foundations, it will be very similar answers. Half of Michigan's private foundations paid out 6% or more during 2018, and again, almost identical to their national peers. Endowed private foundations, again, 5.4 to 5.7%, with a quarter paying out 10% or more annually. And inside that quarter, that does include, again, those both larger and smaller, but the endowed foundations. We've separated out the non-endowed from that conclusion. So even taking out those non-endowed funds, still 1 in 4 private foundations pays out more than 10% annually. Those non-endowed private foundations, again, that was one of the surprises. It caught us 2 ways. One is foundations paying out more than 100% of corpus. So we changed the math, adding those annual contributions in as if they were part of the endowment. And second, running that analysis separately. So pulling them out as a group. Median annual payouts of that non-endowed group approached 70% annually. A quarter or more of those non-endowed paid out 90% or more of their corpus. I'll turn to Casey to wrap up the scenarios, and then Brittany will talk about next steps.
Thank you, Jeff. Just final conclusions on the scenarios. Using the internet era assumptions, again, when we look at the payouts and the different scenarios that we looked at, in particular the 10% temporary draw, it could take up to 20 years, as we showed on the slide previously in the presentation, to get back to that real portfolio balance of $1 million. And what that means in terms of grants is you increase your grant payments for that temporary period initially in the scenarios that we looked at the first 3 years. But ultimately, because that balance is then below $1 million through years 4 through 20, then the payout rate, if you revert back to a 5% number, is then going to be below that initial $50,000 amount for those years 4 through 20. And so with that, I will pass it back over to Brittany to kind of wrap us up and talk about next steps.
Thanks, Casey. So this is, as we said, phase 1 of a multi-phase study series. So the first phase is solely looking at private foundation payout rates and investment returns. Phase 2 is sort of the addition to phase 1 in that it looks at payout rates and a little bit of investment returns that you saw here, solely looking at community foundations. And then phase 3, which will be later this year, we hope to have that data ready by summer. We'll be looking at donor advised funds. As you can imagine, that will be more of a sampling methodology as opposed to a broad-based 990s, but we're debating what that will look like exactly at the moment. So that is the phases of the research itself. If you're looking for more information, you're curious where you'll see this data next, we will be presenting this at Foundations on the Hill here in a couple of weeks with a little bit of an advocacy spin with some additional speakers. So feel free to join us for that. Also, if you're a community foundation member of CMF, you will see a sort of focus on the phase 2 research and what those results are. I believe it's at the end of the month, and then we're talking about a number of other presentations throughout the next year at various conferences, things. So definitely keep an eye on the website. And if you have questions, feel free to reach out to any of us. We're happy to provide more information or tell you where we'll be presenting next as we come out with more results, more information, and I believe, if we're lucky, some blog posts through the Johnson Center. So you'll see quite a bit of this. So with that, we're launching into the Q&A and conversation, and I'm seeing some questions come in, which is always positive.
Yeah, thanks everybody for typing those questions in. We can also use this time for you folks to say your questions out loud. So if you'd like to do that, you can just use the raise hands function, and we'll call on you to talk. But in the meantime, yeah, we have a series of questions for the panelists. So let's start with let's see. We've got a question first here from Kate for you guys. So. This analysis has a focus on the investment return forecast, but largely the analysis seemed to ignore the other side of the equation. That is, your analysis hasn't taken into account the argument that not adequately addressing problems and needs today may mean that those problems, needs, and associated costs are ever increasing and perhaps become more costly to fix down the road. Did you think about this, and how does it shift potentially the conclusions drawn?
I know from the Johnson Center perspective, there were a number of variables that could affect any of those conclusions. We wanted to focus on kind of the math and what the finance and the investment side says is possible. We recognize that some private foundations are spend down. We recognize that others are chartered with perpetuity in mind. We recognize just a number of different aspects and takes on the foundation side. So we wanted to keep this more on the what will the math support to guide and influence those board and investment committee discussions as we go forward. Brittany, I don't know if you want to add anything else from the CMF perspective on that question.
Yeah, I think it's trying to think the best way of saying this succinctly. I think what Jeff is saying is right. It's the fact that at the end of the day, this is what the math says. Boards, institutions are free to make other decisions based on individual community needs, based on mission. And we're just looking at, providing foundations with the data that they can make informed decisions without saying, oh, now we're surprised 20 years down the line that this is what this very mission-oriented perspective leads us to. If that's your decision and you're going in informed, that's fine. We don't want you to be surprised. And so a lot of it is looking kind of at that side of, you don't want to walk in without all of the information that you need in order to make an informed decision as a board member, as an executive, as a family member of a family foundation. I talk to foundations all the time, and it's amazing, especially if this is not your professional role. They do look to studies like this in order to make good decisions. And so it's important to have that. We went into it knowing that there are so many perspectives and so many missions and so many communities being served. And also going into it in the midst of COVID, you have to realize and recognize that that is what's going on and that the need is immense. And so that is always in the back of your mind when you're looking at this kind of data. Hopefully that helps.
Great, thanks all. We have another question here from Sarah at Plante Moran. With the popularity of donor-advised funds, were you surprised to see foundations being used as a pass-through? Realize that this is likely a small group. Will be interesting to see if the number of foundations doing this decreases over time.
Yeah, and it's one of the research questions that immediately came to my mind was, and again, especially since a number of those, I'll call them, like, as you said, pass-through private foundations were created, I'll call them more recently, meaning the last 5 or 10 years, when certainly donor-advised funds were well-known and easily accessed. I'm curious, as we get into the phase 3 donor-advised fund study, do we see a material difference? Like, our donor-advised funds, do they kind of stop around $1 million? And, a donor-advised fund with more than $1 million of balance is like the 90th percentile. So these kind of pass-through funds, are they really donor-advised funds by another name, meaning they're just really, really large funds that people felt more comfortable setting up as private foundations? Or do we also see kind of a split here, that some families or entities are choosing the private foundation route for the same amount of kind of corpus or endowment, that others are making the choice to go straight to a donor-advised fund? As with many things, I think those donor-advised funds are seismic in the land of philanthropy, especially in the last 10 years, and more so. I'm sure many people on the call have seen the Fidelity Charitable Report, I think that came out in the last week or two, with some of their fund balances and payouts. Massive amounts of money, and they are a force to be reckoned with, and still quite honestly figured out across the field in a number of different ways.
Great, thanks, Jeff. We have a few questions here regarding payout, so I'll ask the first one here. From an endowed foundation perspective, is it fair to conclude from your research that a grant payout in excess of 5% policy is not sustainable if we look 10 to 20 years out? And this is asking the question from a college endowment foundation perspective.
I think I can probably take that one, Trish. And I think the answer is going to be, I mean, obviously it depends on the specific foundation, because you're going to look at a variety of different factors for a foundation to determine whether or not the policy that you're looking at is going to be sustainable over a 10 or a 20-year time frame. When we look at the foundation, the private foundation universe as a whole, the returns from 2014 to 2018 would say no, given how those foundations performed. Now, obviously, that's only a 5-year time frame, and it's private foundations, not a college endowment foundation. When you look out over a longer term time period and maybe look back at some of the Cambridge studies that showed longer term historical returns, I think right around that 5% number, looking at the tables from the prior studies, 5 to 6% was the most common type of real return over the longer term periods. It would be difficult to say that something meaningfully above 5% would be sustainable. And so based on those numbers, 5% appears to be kind of in that ballpark of a sustainable number, given what we've seen historically over those types of time periods, a 10 or a 20-year time frame.
I think, Casey, you'd also point out that in our study, when we talk about, like when we showed the returns compared to the model portfolio, we need to remind people that we were showing the median return, that there are plenty, again, with 50,000 foundations in some of the years that we studied, there are thousands of foundations above the 75th percentile, meaning they are earning well in excess of those model portfolios. We wanted to focus that kind of midpoint, that place where half the foundations earn more and half the foundations earn less. So in addition to kind of the need, I think it also, you would say it also depends on your portfolio, that there are foundations clearly earning well in excess of the model. But again, by definition, at the 75th percentile, that means only 1 in 4 foundations is earning at that point or higher.
Right. A foundation portfolio that is invested in 50% equities is going to have a different sustainable payout than a foundation portfolio invested 100% in equities over a 20-year time horizon, just given the return expectations for those two portfolios.
And I think too that probably bears, I don't have the exact number in my mind, but again, had you stopped me on the street and said, define a private foundation, I would have said, oh, it's this entity that has 10 or 20 or $30 million of endowment. And the median private foundation isn't that big in the United States. I want to say the median private foundation is below a $10 million corpus. I think whatever the actual number was from the tax returns, I just know it surprised me. It was a lot lower than I thought it would have been. So kind of like we all walk around with nonprofits, and not we all, many people walk around thinking that a mid-sized nonprofit is $500,000 to $1.5 million in annual budget. That's not a mid-sized nonprofit. That's headed actually well past. That's a fairly large. Half of all the nonprofits file a postcard or a 990 EZ. Which by definition stops at $200,000 of annual revenue. So kind of like, I think we all have an inflated picture of kind of what a typical nonprofit is. I think there's also across the field an inflated picture when we're thinking about private foundations as a whole. Our minds naturally gravitate toward, the Gates Foundation, the Packard Foundation, the Kellogg Foundation, and we think, oh, and then it's much smaller. Those are really, really big outliers compared to the 50,000+ private foundations in the United States.
I would also add really quick too, that I think people always assume that private foundations, there is not a contribution coming in, that there's not active family members, that in a lot of cases, there's not an active company, that there's a lot of corporate foundations, especially in Michigan, that are putting money actively in and actively making grants out. And we see that a little bit too, previewing a little bit of the community foundation sides, but as you're saying, a college endowment foundation, the fact that you have the possibility of contributions coming in, the way that you look and think of your investments and your endowment strategy and your grant making is a little bit different, because there's a possibility that money can come in, as opposed to someone who says this is the absolute max it can be, except for investment income. So you kind of have to, even though everyone's looking at, well, this is the box of private foundations, this is the box of community foundations, how they work internally is not the same from one foundation to the next. So you kind of have to think about it almost at that individual scale, even as we're looking at this incredibly macro level of the data.
Great, thanks all. And feel free to keep asking questions all. We do have another question around payout, kind of from the public policy perspective. So what do you see as the implications of your study for policy proposals to raise annual payout to 10%? Did you conduct projections using any of these proposals with the models you developed?
So yes, both the 7% and 10%, because again, on what's being talked about both in the trade press as well as Washington, D.C. changes frequently. That's why we used kind of 7% and 10% to not pick a single number. And we said, what if a temporary 3-year increase in that payout? So we use those as kind of models or proxies for variations on kind of the 5% payout model. At the end of the day, looking at the numbers, having these results in hand really doesn't change the kind of grounding questions that were asked, even if you didn't have those models in hand. And that is it better to pay out money sooner or later? And if you're trying to make a difference in the community, which is the greater good? A sustained investment over time, or kind of an influx of money in the short term and a decrease of money in the later term? Again, thinking back to that last slide that Casey presented, with large amounts of money in the first 3 years, but then payouts actually drop below the kind of 5% steady eddy payout across time. Those questions were there before we ran our study, and our study kind of brings you right back to that same point of, we are trying to point a path to say, this is the mathematical, the financial, the effect on corpus of those kinds of decisions. So as policymakers, as foundation boards and trustees and family members and investment committees have those same conversations, they can add this kind of data perspective into that table and into those conversations.
Thanks, Jeff. Another question on payout too, from a community foundation frame of reference, in the early 1990s, the grant payout formula from endowments was 4% plus 1% for administrative expense for a total of 5%. Do we still talk about the 4% golden rule to assure endowment building over time, or have we moved away from that approach?
Yeah, I think that's, again, going to be a kind of foundation specific type of answer based on your investment portfolio and the expected returns around that. I think what we've seen since the 90s is expected returns coming down for investments, as Jeff talked about, as interest rates have moved from where they were, more normalized levels, down to below 1% or around 1% today. And so when you look at the level of expected returns on a go-forward basis, that has changed dramatically, obviously, since the 1990s. But the answer to that question is going to be largely dependent upon the specific foundation's asset allocation and how much risk is involved and how much return would be expected based on that portfolio.
And remember too, we as we showed very early in the presentation, the median private foundation investment return was 1%. The median community foundation return was 1.6% annualized. So we are seeing that community foundations earned a little bit more on their investments than private. What we don't know is, again, we've got 80,000 observations on the private foundation side and 800 on the community foundation side. So we don't have enough, even if I could run the statistical test, I don't know that this is a case where, if I could prove statistical significance, I don't know that in the real world it would really matter. So we're watching that, and this is some of the work we're doing in the finalizing the community foundation studies, kind of do some more digging onto, can we see a difference or explain why? But at least on its face, as we ran, as Casey pointed out, that the best apples to apples comparison we could do using two different sets of tax forms with two different sets of reporting requirements, we're seeing community foundations, the median at least, earning just a little bit more in investment return, but still below the model.
Yeah, in terms of best practice too, the thing I hear most often is, well, if there's a private foundation expectation, then the community foundations kind of use that. You can phrase it differently, as inspiration, as a baseline, as best practice. So that's what I'm hearing from organizations, but it also depends on, who is on your investment committee, who and what group are you working with to manage your endowment. All of those things make a big difference. What's your strategy for investments? Do you want to invest locally? Do you want to invest internationally? Those are all, much bigger, broader questions than we have room for here and beyond the scope of the study.
Thanks all. Let's see, do we have any other questions for our panelists here, or any thoughts from the panelists as these questions come up? Otherwise, seeing none, you will get a copy of this as well. And I believe there's the contact information of Jeff and Casey and their team if you have any follow-ups. But maybe I can turn it over to Jeff or Casey or Brittany. Do you have any closing comments or thoughts?
I would just encourage people to continue reaching out. We had a number of emails and great comments from the January webinar, so please follow up with us as you get the presentation and the recording if you have additional questions and comments. And just leave it to Brittany maybe to remind everyone kind of the next times that they'll hear from us and kind of the next pieces that are coming up. But from the Johnson Center side, thank you, everyone.
Yep. Thanks everyone for your attendance today, and thanks for all the questions.
Yep, and you should be hopefully through CMF and the Johnson Center seeing an announcement within the next couple weeks of the Community Foundation payout study coming out. So,
All right. Well,
Look
thank
forward to it.
you, Jeff, Brittany, Casey, Teri, for being on the panel today. And thanks everyone for coming out. We'll end the session here.